Great.
Okay, let's get started. Hi, everyone, and welcome to tonight's webinar. My name is Rafi Shulman, and I'm one of the co-founders of Olim Advisors. We're an organization that started in about 2016 with two goals in mind. One goal is to help people make Aliyah, and the second goal is to help a lot of the Olim who live here already to overcome the day-to-day challenges. One of the topics that comes up a lot are taxes. It's a very confusing topic, especially if you're filing for multiple countries. So, if you're filing just in the US or Israel, that's challenging in itself. But if you're filing in, multiple countries, then it becomes a challenge. And so as people reached out to us and were looking for advice, we went out and we looked for a tax firm that could provide useful information. We looked for a tax firm that also has Israeli tax advisors and US tax advisors underneath one roof. And we got introduced to Grant Thornton, and we decided to do this webinar with Grant Thornton for two reasons. One is because of the stellar reputation that they have both globally and more importantly in Israel. And secondly, because they have accountants and tax advisors who work on the US taxes as well as the Israeli taxes under one roof. And so in a moment, I'm going to hand it over to Yakov Bernstein and to Ariel and Katz, who will go through the presentations and we'll share with you some of the thoughts and some of the advice that they have. Before I hand it over to them, I just want to mention a couple of things. First of all, we are going to do a Q&A session at the end. So if you have any questions, feel free to type them into the chat and we'll get to them at the end. Just keep in mind that we only have limited time, so we can't get into a lot of detailed information and answers, but I do encourage you to reach out to either Yakov or to Ariel after the webinar to talk to them about your specific situation. And the other thing, as I mentioned earlier, we will be recording this and we will send out an email with a link to the recording. So with that in mind, I'll hand it over to you, Ariel and Yakov, if you want to take a moment and introduce yourselves. And then Ariel, you can go through your presentation. I'll share the screen, and then Yakov can follow up after you.
With pleasure. Okay, so my name is Yaakov Bernstein. I'm a lawyer and a CPA here in Israel. I'm a senior tax manager at the tax department of Grant Thornton Israel. I deal with a lot of international and Israeli tax-related issues, representing individuals and companies. And I'm very happy that I was invited to share some of the knowledge with you today. Thank you.
Thank you. Ariel?
Yes. Good afternoon. My name is Ariel Katz. I head the U.S. tax group at Grant Thornton Israel. Grant Thornton Israel is the sixth largest accounting, tax, and advisory firm in Israel, with several locations scattered around the country. We have approximately 500 professionals working. Grant Thornton International is a global accounting, tax, and advisory firm with multiple locations in the United States, England, the European continent, and across Asia. Today, I will be speaking about the proposed tax plan of President-elect Joe Biden and the actions that should be taken or considered before year end. Among these are several changes enacted earlier this year as part of a record economic relief package in reaction to the coronavirus pandemic. Others are long-known techniques.
Okay, I'm going to just pause for a moment and just share the screen here and just make sure that everyone can see it there. Okay, can everyone see the presentation?
Yes, yes.
Okay, Ariel, so go ahead and I'll fast forward as you go through the presentation.
Great, if you could turn to the next slide.
Okay.
So a starting point goal of increasing benefits and income revenues to the middle America, middle taxpayer, at the same time as reducing benefits and increasing the tax rates on high income, wealthier Americans. There are several components of his proposal. All of them basically are looking to attack the main goal of eliminating the 2017 tax reforms that went into place. And we're going to look at some of these first on an individual level and then on a business level. If you could please change the slide. So President-elect Joe Biden's plan includes the following income tax, corporate tax, and estate gift tax changes that affect all US citizens from all walks of life. Looking at the changes that will potentially go into play during this administration, for individuals, it reverts or pushes back the top individual income tax rate from 37% for the highest income earners to 39.6% for those earners. And again, high income tax earners are defined as those with taxable income greater than $400,000. Along with the increase in income tax, taxes on capital gains and qualified dividends for those with income greater than $1 million will be moved up to almost 40% from the rate that currently stands today at 20%. Now that rate of 20% will stand for all income earners below $1 million. Next slide. As I mentioned earlier, the Biden plan seeks to increase benefits and available income to middle income, middle earners. And two methods that he does have in mind are increasing or expanding the child independent care tax credit from today's $3,000 in qualified expenses to $8,000 per dependent, with a maximum of $16,000 for multiple dependents. In addition, something that all Americans living in Israel are familiar with is the child tax credit. For 2021, and as long as economic conditions require, the Biden plan is going to increase the child tax credit to a value which currently stands today at $2,000 to $3,000 for children under 17 years old, with an additional bonus or kicker for those with children under 6 years old. Now, the main benefit of this particular aspect of the plan is that the full value or the full amount of the child tax credit is refundable in cash, up from today's 75% of the credited amount, or $1,400. Next slide, please. On businesses, the new proposed plans will increase the corporate tax rate from 21% to 28%. It doubles the tax rate on what is known as global intangible low income tax income, or GILTI, earned by foreign subsidiaries of US firms. That rate will go up from 10.5% to 21%. The reason I bring this up is because GILTI also affects those that have CFCs, or controlled foreign corporations, which many Israeli small companies are characterized as. So if you're a dentist that has a company in Israel, or a lawyer that has incorporated, or someone that has opened a small manufacturing firm, and you are receiving benefits or reduced taxes due to where you're located in Israel or the type of profession that you're in, business that you're in, then the GILTI income may be come into play and might affect you. Next slide, please. As I mentioned in the beginning, one of the overriding points of Joe Biden's plan was to increase taxes on high income earners and wealthy Americans. And a mainstay of that plan is to increase the revenues that are drawn from estates. The way that the Biden plan will work is that the estate and gift tax exemption, or amount that is not taxable in the United States, will decrease from today's current $11.5 million per individual to $3.5 million per individual, and the tax rate will increase to 45%. In addition, a very controversial aspect of his plan would be to eliminate the step up in basis for capital gains taxation for inherited property, and that tax would be, the burden would be carried by the heirs or inheritors. So this is a very controversial aspect of the plan. It hasn't been discussed in great detail, and it should be followed closely. In addition, the reason I bring up the estate and gift tax is because while those U.S. citizens that, God forbid, are not passing away in 2020, it is not too early to think about estate and tax planning by wealthy Americans. And in part of that is gifting part of your estate to your descendants. If you were to make a gift in 2020, that gift would fall under today's exemption ceiling of 11.5 million, saving yourself thousands and possibly hundreds of thousands of dollars in taxes. Next slide, please. So now that we've talked about some of the proposed changes that might come into play next year, let's talk about some of the actions that can be taken place in this tax year that we can all benefit from. The first is charitable giving. As part of the Coronavirus Act, the Congress carved out a new deduction for as much as $300 for donors who choose the standard deduction for the 2020 tax year. The standard deduction for the 2020 tax year allows individuals to deduct up to $12,400 from their taxable income, and married couples up to $24,600. So today, if I make charitable deductions, but my itemized deductions are not greater than the $24,000 if I'm married, I don't stand to get a tax benefit from those deductions. Well, with this new regulation, we can benefit from that charitable deduction by using a standard deduction. Next slide, please. For those that itemize, the suspension of a charitable deduction limits for itemized or people that take itemized deductions, and those itemized deductions are greater than the standard deduction limit of $24,000 for married couples or $12,000 for an individual, allows someone to have unlimited charitable deductions in the 2020 tax year, whereas generally those deductions are limited to 50% of your taxable income. Basically, this is the way that Congress is hoping that people will fund programs privately as opposed to through government grants or government subsidiaries. Next slide, please. With regards to capital gains, as there is the prospect of increasing the capital gains rate in 2021 to almost 40% for those with income greater than $1 million, it would be very beneficial if you could take those actions this year in 2020 and harvest those capital gains as opposed to waiting to 2021 and setting yourself up to 20% on taxes. Next slide, please. As I mentioned with the estate tax planning, if you have thoughts of wealth management and planning for the next generation, it might be beneficial to look into putting some of those plans into action in this year. In that way, you fall under the current estate tax exemption ceiling, as well as if you are over it, then you do benefit from a lower tax rate. Something to think about. Next. In summary, based on the tax plan that has been proposed through campaign pledges, speeches, and the party's platform, taxes would be raised on labor income, investment income, and business income of those earning greater than $400,000. While it typically takes a year or so for tax laws to go into effect after they are passed, so if they were passed in 2021, they would be going to effect essentially in 2022, there will be some adjustments made from the very beginning, either through Treasury regulations or congressional actions. The prospect of significant tax change on the horizon remains unclear for now. However, whatever lies ahead, it's a good time to think about future taxes. Now, I know thinking about taxes, especially US taxes while living in Israel, may not be the highest concern of someone. There are infinite ways that individuals living in Israel can get bogged down. What I have found is that Olim Advisors and their guidance allows individuals that just make Aliyah to charter those choppy waters and act as a guiding influence in areas such as healthcare, 𝗬𝗓𝗓𝗜𝗓 laumi, education, and housing. I thank Olim Advisors for giving us this time to speak with you, and I thank you for your time.
Thank you, Ariel. I appreciate it. I'll just put up the slide here with Ariel's contact information so you can jot it down. And again, the email that I'll send out with the link will also have the information, so you can always reach out to Ariel directly with any other questions that you might have. So thank you again, Ariel. I appreciate it.
Of course.
Okay, give me a moment. I'm going to stop my share. I'm going to switch over to Yaakov's presentation here. Okay, Yaakov, up to you.
Thank you. So, as I presented myself, I'm an Israeli lawyer and a CPA, and I assist Israeli and international clients with their Israeli and international tax issues. Can you please move to the next slide? Today, I was asked to present certain issues that could be relevant for Olim Chadashim, new immigrants to Israel, veteran returning residents, which could be relevant for the period that they are staying in Israel, for the end of the year, and for future years. So, as you may know, the Israeli tax system is very beneficial for new immigrants and veteran returning residents, and provides them 10 years of holiday from payment of taxes here in Israel from income that they earned or was generated outside of Israel. In addition, there are also tax benefits to returning residents that are not veteran residents that spent less than 10 years outside of Israel. But for our discussion now, we will focus on new immigrants and veteran returning residents and the tax benefits that they receive. The first question is, okay, so I came to Israel, but from when am I eligible for the benefit, okay? From where do I start counting those 10 years? If you've never been to Israel and you and your family immigrated to Israel on a certain date and you transferred your center of life on that date, so the answer is easy. But sometimes, or for some of our clients, the question is not so straightforward because they had a previous history in Israel. Maybe they came, they got a Teudat Zehut, maybe they came and they bought an apartment here in Israel, but they only transferred their center of life to Israel in a later date. So we assist those clients in order to analyze exactly when should be the threshold when they are becoming an Israeli tax resident. And when required, we also assist them in applying to the Israeli Tax Authority in getting a special tax ruling that states the specific date from which you would be considered an Israeli tax resident. And this could help, this usually helps our clients because it postpones the date from which they are considered Israeli tax residents and allows them to have more years of exemption here in Israel. I would also like to mention that there is a possibility for new immigrants. This is more relevant for our listeners who just arrived to Israel or thinking of arriving to Israel. This is called an adjustment year. This adjustment year enables the new immigrant to choose, and this is an active report that should be done, to choose the first year will be an adjustment year. And this year will allow the new immigrant to come to Israel, to spend a year here in Israel, and in the end of that year to decide whether he wants to stay, and then he will be obligated to all the other relevant issues that are relevant to Israeli tax residents, or he can decide after 1 year that he wants to live and go back to his country or to another country, and then he will be still considered as a non-Israeli tax resident, and there will be no implications for the year that he spent here in Israel. So this is something very important. This, you can choose it up to 90 days from your arrival to Israel. So this is something you should consider. Another topic that I would like to discuss with you is with respect to business income. Most of the new immigrants that are coming from abroad, they have their own businesses already set up in their countries, or they are self-employed, or they are employed by international firms that they provide part of their services from Israel. Part of the services are provided outside of Israel. So few issues that should be considered. First of all, under Israeli tax law, a company that was an Israeli company will be considered a company that was incorporated in Israel, or if it's managed and controlled from Israel. And this issue has wide repercussions for the company, because if it's managed and controlled from Israel, then it will be viewed like an Israeli company, and it will be required to submit an Israeli tax return and report and pay taxes and so on. But there's a relief for new immigrants that allows for the first 10 years that they are in Israel, their company, even if it's controlled and managed from Israel, not to be viewed as an Israeli company, and would not be required to submit any tax returns here in Israel. But you have to understand that the Israeli tax authority still views the presence of the person, the individual, the new immigrant here in Israel that works or provides services to that company as having a permanent establishment here in Israel. Therefore, it means that part of the gains of this company should be reported here in Israel according to the scope of the activity of the new immigrant to Israel. But if all the activity of all the business activity of that individual is done outside of Israel, then there should be no additional presence here in Israel. The same thing goes with is relevant to employment income. Many of the Olim Chadashim are self-employed, and they are providing the same services that they were provided in their home countries from Israel. So part of them travel a lot, and this was before the COVID area. They used to go on a plane and provide the services outside of Israel. So Olim Chadashim have an exemption for 10 years from any source of income that they generate outside of Israel. But for the income that they are generating from Israel, if they are working and providing the services from Israel, let's say if I'm a lawyer and I'm providing my services from Israel, so for the part of the service that I'm providing from Israel, I should report and pay taxes here in Israel. The exemption from tax is not valid on the part of the income. In addition, some tips that if you are planning to come to Israel, or if you just arrived to Israel and you're still waiting to get some payments from your previous employer, then such payments for work that you provided to him before you immigrated to Israel, then such payments should be exempt from tax in Israel. For employees that are working for international companies and they are providing their services part of the time from Israel and part of the time outside of Israel, they can apply to the Israeli tax authority and claim that part of their services should be exempt from tax in Israel. The Israeli tax authority position is that a minimum of 60 days is required in order to outside of Israel in order to claim this benefit. But this is not our understanding, and we think that even a low amount of period spent outside of Israel providing work or services outside of Israel should be eligible for those benefits. Please note that the Israeli tax authority also have special rules regarding how to count the days that you are working outside of Israel. You have to choose if to include Sunday or Monday, and they also have a rule about the leave day and the return day, if they are included in the count of the days that you are spending outside of Israel, of the working days outside of Israel, which are eligible for the tax benefits. Okay, so those are the main issues. With respect to pension taxation, so in general, if you are eligible for a pension now or in the future from your previous employee from your previous country. Then in Israel there are different tracks that you can apply in order to tax this pension. In a general matter, the Israeli tax ordinance states that your situation should not be worse than if you had stayed in your country. So the tax that you will pay in Israel should not be higher than the taxes that you are eligible to pay in your, let's say, from the country that you came from. In certain tax treaties, like the tax treaty with the US, there's an exemption then that pension would be taxed only in the country where the person that's receiving the pension is a tax resident of. So the pension would not be taxed in the US and it should be taxed here in Israel. There's also special rules and a special track for that. You still have to pay taxes on the income, but 35% of the pension should be exempt. Okay, can we please move to the next slide? Okay, with respect to capital gains, new immigrants and veteran returning residents and also regular returning residents have also tax benefits on them. With respect to Olim Chadashim, they have 10 years of a tax holiday on capital gains from their income of the sale of securities or other assets that are held outside of Israel. They can also be eligible to those benefits on assets that they acquired, on securities in Israeli companies that they acquired before they made the Aliyah. It should be noted that in general, if you hold the asset more than over the 10 years of the exemption holiday, there's going to be a linear calculation where part of the gain will be still enjoy the exemption, and part of the gain after the 10 years would be subject to tax here in Israel. It should be noted in this purpose that dividend that you might receive, it's very important to receive them before, if it's a fully owned company or it's a public company that you're holding, it's important to receive them before the end of the 10 years because the dividends are taxed upon receipt. And if you receive them, even if the income was generated before the 10 years ended, but was received after the 10 years, so the dividend would be subject to tax in Israel. So it's important to receive them before the end of those 10 years. And this is also relevant for new immigrants that are employed by their own companies. And it's important if they have accumulated income in those companies to distribute them to Israel, to distribute them to themselves before the end of those 10 years. The trust issues is something I want to only address in a very high level. It's a complex issue. It's a case-by-case case that should be examined, but you have to understand that when you come to Israel and if the creator of the trust or one of the beneficiaries of the trust becomes an Israeli tax resident, then there's an implication on the trust itself, and maybe and this should be examined if there's no requirements to reporting or to pay tax here in Israel. So this is very important because it could be very substantial. I want to point out again, under the Israeli law, and this is something that many people don't know, there's an exemption for interest income that new immigrants can be eligible for by declaration to the bank. This is benefit could be received by providing a declaration to the bank and this will provide exemption on interest on the foreign currency account for a period of 20 years from the Aliyah. So, but this is only relevant for money that you will bring from the period before you made Aliyah. So this could be a very interesting benefit, although the tax rates now are very minute, but still it could be something interesting. And the last point I want to discuss with you is the exemption from reporting to the Israeli tax authority. In general, there are requirements from Israeli tax resident to submit a tax return to the Israeli tax authority if certain conditions are met. If you have income that was not taxed, then you should be then you have to report and to the Israeli tax authority. But new immigrants are exempt for those 10 years during the tax holiday period from reporting on their income that is exempt from tax in Israel for the period of 10 years. And but this is something interesting that you should know, that if during those 10 years you set up a foreign company, that although this company would not be subject to tax in Israel during those 10 years, but the exemption applies only to a company that was incorporated before you made Aliyah, and not after. If you're already an Israeli tax resident, then technically you need to report regarding this company, but there's no tax to be paid. So this is something that should be noted. Okay. This is a very, very general, because we don't have a lot of time. So this is a very general overview of certain issues that could be relevant to new immigrants. I hope you enjoyed our very high-level topic discussion. Of course, if you have any additional questions or you need some other assistance, we will be happy to assist. Rafi, thank you for having me here and addressing those issues.
You're very welcome, and thank you, Yakov, and thank you, Ariel. I think this information that you shared was really helpful. I'm going to just stop sharing the screen for a second, and we'll check and see if there are any questions that come up. It says here, there's a question here from David. What if you've been here longer than the 10 years and received dividends? What are the implications in that case?
For the 10 years, you are subject to tax on those dividends as any other Israeli tax resident.
Okay. And then from Joe.
But if I can suggest, maybe look if you can find a different alternative of receiving the money than a dividend. So, but after the 10 years, you are more limited in your ability to tax structure. But if this is relevant, then you can contact me and we will analyze the specific issues.
Okay. And then from, let's see here, from Joe, practically speaking, how much time do you have to make changes in your retirement plans?
How much time?
It says here, practically speaking, how much time do you have, I guess, to make changes? I'm not sure if that's clear to you. Maybe Joe.
With respect to retirement, so technically for the first 10 years, you are exempt from any taxation on foreign source income. So this includes also the pension. After the 10 years, you will be subject to tax here in Israel according to the different tracks. So it should be examined what is the more beneficial tax track that you should choose, and you will be taxed accordingly.
I do want to mention, if I can,
Sure.
that for those, I guess, retirees that receive Social Security in the United States, Social Security from the United States is not taxed in Israel, as well as the 𝗬𝗘𝗓𝗓𝗜𝗓, should somebody be receiving it, is not taxed in the United States. This all falls under the U.S.-Israeli tax treaty.
Okay. Let's see what else we have here. You might have answered this, but I'll just ask it again. Do you have to pay taxes on dividends in both the US and in Israel?
So technically, it depends where is your residency, okay? So, okay, so it goes like that. Usually, the dividend is considered as income by the company that is distributing the dividend. So, if depending on the location of the company that is distributing the dividend, okay? So, if tax was not withheld by that company in that jurisdiction, okay? The first jurisdiction, if you're an Israeli tax resident, then it would be in Israel. So you'll have to pay the tax or any additional tax that you are eligible, that you are required, you will pay here in Israel. And usually the Israeli tax is higher than the US tax. Correct me if I'm wrong, Ariel. So
No, it is.
Yeah, so you won't have to pay any additional tax. But let's say if you pay a low tax here in Israel, in theory, then you'll have to pay additional tax in the US. Because, yeah.
And then there's a question.
If I can clarify.
Yeah, please.
Rafi. Sure. So if you're sitting in Israel and I receive dividends from my 𝗪𝗪𝗕𝗜𝗡𝗦 Olim stock, I pay taxes in Israel on those dividends. And then when I file in the United States, I have to disclose the dividend income that I received, but I get 100% tax credit for whatever taxes I paid on those dividends in Israel. And vice versa. Should I receive dividends from my IBM stock that I hold in America, I'll pay tax in the United States on that. And in Israel, I'll get a credit on the tax that I paid in America, 20%. And in Israel, I'll owe a differential due to the higher tax rate in Israel.
I see. Okay. Then there's a question here about foreign deposits. What interest on foreign deposits? What interest, I guess, is paid on foreign deposits?
Okay, so I don't know the interest because we are not in the bank, but you can ask your bank, but and also ask them if they what kind of declaration you have to prove, because you need to prove that you bring this money from outside of Israel. Okay, this is money that you brought before you had before you made Aliyah. So this is also, it's a procedure with the bank. But again, the bank will give you the interest that it gives. But you should get a tax benefit that you will not have to pay taxes on that income, on that interest.
I understand. Okay. Then there's a question here. If 10-year anniversary is in August, do I have to pay taxes for the whole year or just for that part?
So it depends on what kind of tax structure do you have. Okay, so they didn't detail, but let's say if if their income is generated by employment income, okay, so only income that they generate after August, okay, or they said August, October, after the end of the 10-year period, okay, and if their income is from rental, okay, so again, the rental income that they are receiving after that period. But if, let's say, they will distribute a dividend after the 10 years ended, so they will have to pay tax on that dividend, even if part of it was income that was generated before the 10 years.
I see. Okay. And then there were a couple of questions that were emailed to me beforehand, so I'll just read them here. One question, actually two questions about self-employment taxes. What do you have to pay in the US and what do you have to pay here in Israel? I know that, 𝗬𝗘𝗓𝗓𝗜𝗓𝗑 and self-employment taxes don't offset each other. So maybe, you can just talk a little bit about that.
Certainly. So As an Osek Moshe, you are required to pay B'tuach Leumi and the other assorted social taxes that Yaakov can speak about. However, when we get to filing the U.S. tax report, you're also required to pay Social Security tax as well as Medicare tax if you are self-employed. And that self-employment tax is not only the employee's share, but also it has to cover the employer's share. So in total, you're paying approximately 16% for Social Security and Medicare in the United States.
I see. Okay. Let's just see. I
the,
think we've.
Yeah, from
Yeah,
the
go ahead. Sorry,
Israeli
Yaakov.
only to add that from the Israeli point of view, because you're working in Israel, so the Israeli tax authority has the right, is the first right to tax you. And in Israel, you're paying taxes according to your income bracket. So the higher your salary or your income, the higher the tax rate would be, but it will be only on the additional bracket, okay? So, and it could get up with Bituach Leumi, okay, national insurance, it could be up to 50%. The highest bracket is up to 50%.
Okay. There's a question here about cash donations in the U.S. up to $300. Do they need receipts?
So, with regards to the that $300 charitable donation deduction, that charitable donation must be made to a qualified charity. In other words, a registered charity. And as a registered charity, they're required to produce or issue a receipt to you. So therefore, the answer to that is yes, you do have to have a receipt. If you've lost it, you can always contact the charity, but I would recommend receiving one.
Okay. I think that covers it. Let's double check. I think we've gotten to all the questions here. So again, Ariel and Yakov, thank you so much for joining us tonight. Thank you all for joining the webinar. Again, if you have any questions, or if there are other topics that you would like for us to cover here at Olim Advisors, feel free to reach out to me, and of course, reach out to Ariel and to Yakov for any tax questions that you might have. I think really, like I mentioned at the beginning, it's great to have two tax advisors covering Israel and US under one roof, and I think it's something that a lot of people are looking for. So thank you, everyone. Thanks for joining us, and have a good evening and a good rest of the week. Take care.
Thank you.
Bye-bye.
All the best.